The FDIC, right, the Federal Deposit Insurance Corporation, is making some really strange changes, and nobody seems to be paying attention. Let's dive into it. All right, so the FDIC change that leaves wealthy bank depositors with less protection. Interesting, huh? New rules implemented last month capped what the Federal Deposit Insurance, the FDIC, will insure in a trust account at $1.25 million. Okay? Before, there was no limit on trust accounts, which are legal arrangements that ensure an individual's assets are distributed to specific beneficiaries. Now, this is kind of interesting, right? Because it's supposed to be your money. This is supposed to be your value that you've stored into the future. And now all of a sudden, this FDIC, right? This corporation that literally has one job, which is to insure the deposits, is now putting a limit on the amount of deposits that they insure. Anyways, all right, let's continue. The FDIC said the new rule will make it easier for consumers and bankers to understand deposit insurance rules. What? I'm going to read that again because that sounds absolutely insane and ridiculous. The FDIC said the new rule will make it easier for consumers and bankers to understand deposit insurance rules. How? How will that make it easier? Before, there was no limit on the amount of dollars that you could have in a single trust. That seems pretty straightforward, right? As much as I put in is as much as insured. I mean, that's about as simple as it gets. All of a sudden, they throw in this limit. This limit actually complicates things, and I'll explain why after. Anyways, it is also designed to help the FDIC agents more quickly determine which accounts are insured after a bank fails. That is complete fucking bullshit, okay? It's very simple. They had no limit, which means everything was insured up to the amount that you had. Now they just placed an arbitrary limit. This is like, I'd like to say it's gaslighting, but at the same time, I genuinely feel like the people who put these rules in place think that we are all complete morons. Genuinely. And I'd be very surprised if the wealthy of this country would actually put up with this crap, because all it's going to do is create more complexity for them. And again, I'll explain why after. So here we go. The change could lower how much in those accounts are insured if their financial institutions fail. Those affected may need to restructure their deposits or open new accounts to another bank to ensure their funds are protected. That's right. This has nothing to do with you. This has nothing to do with clarity. This has nothing to do with transparency. It has nothing to do with a better consumer experience. What it does do is introduce complexity, and if you don't follow and make changes, then now all of a sudden your trust, the dollars in your trust, if they go over 1.25 million in a single account, well, guess what? The state owns it now. That's right. It's gone. They just take it from you. It's nice. It's somewhat of an obscure change. No, it isn't. And the loss of some insured deposits is something I'm not sure the FDIC has highlighted enough. Well, of course not, because there would be outrage. There may very well be a lot of depositors out there that might not have the insured deposits they had assumed when they originally opened the account. That's the idea. That's why they do this, right? Remember, everything is framed as helping the consumer. It is all about, there's something that, a term that we used in technical support, it's called CYA, which is cover your ass, okay? And this is exactly what they are doing, okay? That's all it is. There's a reason why this isn't being made into a big to-do, because there would be outrage, there would be backlash, and unfortunately, the backlash that would come wouldn't be from the simple poors and plebs like me. No, they would come from some of the wealthier people in this society, people who, you know, through the proof of stake mechanism have, you know, garnered some power and support. So, you know, it's nice to keep this stuff quiet. It's good. It's good. What isn't changing is that the FDIC, so here, this is a little bit of the watch what this hand is doing so you don't pay attention to what I'm doing here. What isn't changing is that the FDIC still insures up to $250,000 per depositor and per account category at each bank. Here's how that works. Don't pay attention to what we just said before. Pay attention to this, what we do insure. Say you have $250,000 in an individual savings account and $50,000 in an individual checking account at Bank A. That means you, the depositor, have $300,000 total in one type of ownership category, single accounts, at the same bank. So only the $250,000 is insured. If you moved that $50,000 to another bank, it would be fully insured. Similarly, if you put the $50,000 into a joint account, which is a different ownership category, the amount would be fully insured even if it stayed at the same bank. That's right. You introduce complexity, and the reason why you introduce complexity is to essentially ensure your own moat. I used to work for an engineering director that used to tell us that complexity is good, right? And the reason why complexity is good is because it allows you to monetize your customer further, okay? It also helps the scenario where when you introduce more complexity, you end up having a customer that has more pain, and that pain equals more opportunity. And I know you'd say, Phil, that sounds completely insane. Why would people do this? Incentives matter, and the incentive is to get paid. Now, these guys, the banks, they are incentivized to go along with this because guess what? This means more accounts, right? The wealthier people are going to have to split up their funds across more accounts, which introduces more complexity. And then all of a sudden, right, this can lead the way, pave the way for more pointless fees from the banking institutions for managing your money, right? Anyways, trust accounts provided a loophole to ensure more than $250,000 under the old FDIC rules. So here's the reframing, right? This was a loophole that we gave you. We're going to close that loophole now, right? Make things fair. This is fucking nonsense. Anyways, each beneficiary of the trust would get $250,000 in insurance protection. So, for example, if the trust named 10 beneficiaries, then the account would be insured for $2.5 million. Oh, okay, so you choosing to do what you want with your money, that's a loophole. This is psychotic, people. This is psychotic. Anyways, before this change, many people weren't aware that you could theoretically insure almost an infinite amount at one bank through the FDIC rules through a trust account. The new rule limits the number of trust beneficiaries that receive the $250,000 insurance amount to 5, totaling at most $1.25 million. Additionally, irrevocable trusts and revocable trusts are now lumped together into one ownership category, trust accounts, under the new rules. The new category also includes any deposit account that has named beneficiaries upon the owner's death, such as a certificate of deposit or CD. So the trust that previously was insured for $2.5 million for its 10 beneficiaries is now insured only for $1.25. Haha. There you go. That's what you get for putting your money in a place they told you to put your money for it to be safe. It's punishment time. When the FDIC proposed these rules in 2022, a year before talk about lifting the $250,000 insurance cap bubbled up during a run of bank failures. Oh, that's interesting. It estimated that almost 27,000 trust accounts depositors and just over 36,000 trust accounts could be directly affected by this aspect of the final rule. So you see what they did, right? They goose-stepped us, and this is what I've said from the beginning, right? A lot of people seem to think that all of a sudden, one day to the next, you're just like a prisoner in this system, right? All of a sudden, one day to the next, the rules change. That's not how this works. The rules change slowly so that you come closer and closer to accepting things that are actually not beneficial for you, okay? They just goose-step you in that direction. A small number of irrevocable trusts could see an increase in insurance coverage under the new rules, the FDIC said, while overall most depositors should not see a change in their coverage. So this is, again, more bullshit, okay? How would you possibly see an increase in insurance coverage if they literally just lowered the amount? They just made it, like it was infinite. Now there's a cap. So there's no universe where that makes any sense at all, okay? And the last piece of that, right, while overall most depositors should not see a change in their coverage, that's because most depositors don't have that much money, okay? So that's right, the average person, they don't give a shit about this because the average person doesn't have that kind of money. This only affects the wealthy, right? The wealthy and the wealthier. So I'm sure this is fine. If you find that some of your money is now uninsured, talk to your bank. Financial institutions typically work with customers affected by regulatory changes to ensure their large deposits are protected. No, they're not. They're forcing you to split your money up amongst multiple accounts, which I'm sure will be used as a metric to somehow prove that the banking system is safe and secure, because look at how many more accounts, trust accounts we now have. Anyways, you may end up needing to open a different type of account or put the uninsured sum in an account at another bank. How exactly does that help you as the consumer? I have no idea how this actually helps you. Some people don't seem to necessarily be aware of how the Federal Deposit Insurance Corporation gets its funding, so let's take a look at it. One way the FDIC maintains stability and public confidence in the U.S. financial system is by providing deposit insurance. The primary purposes of the FDIC, or the DIF, sorry, are to insure the deposits and protect the depositors of insured banks, and two, to resolve failed banks. While the DIF is backed by the full faith and credit of the United States government, in other words, backed by the government enforceable violence and the fact that the government is the only one that is allowed to issue currency through the printed gymnastics of the Federal Reserve, it has two sources of funds: assessments, insurance premiums on FDIC-insured institutions, and interest earned on funds invested in U.S. government obligations. Revenue from assessments and interest on investments add to the DIF balance or fund net worth, while losses, primarily from bank failures and operating expenses, reduce the balance. So, in other words, there is no reason whatsoever for them to be doing this, okay? There's no reason at all, okay? This is the only thing that I can think of, is that, unfortunately, we are going to have a crisis, right? At some point, something is going to happen, because don't forget, 2 years ago, right, they made the limit of the $250K on the individual accounts. Now, all of a sudden, they're capping the trust accounts, which means anything, whoever doesn't make these changes, and anything over 1.25 million is just instantly lost and reabsorbed into the system. That's right, guys. They are closing the exit ramps. That's what I believe. I believe the exit ramps are being closed. I believe that Bitcoin is obviously becoming significantly more important. Guys, were you aware of these FDIC changes? I just found out by fluke while I was flying home. So crazy times. I'd be very careful for the Bitcoiners that, or the Bitcoiners that do have that kind of money in a trust account. Definitely find out more. And unfortunately, right, your only recourse, you have what, two options? Pretty much you get rid of those trust accounts and you turn it all into Bitcoin, or you start playing the game of musical chairs that the banks want you to play. Anyways, guys, glad to be back. That's it for today. That's the clip. I am going to catch you all tomorrow.